Okay, so we're going to begin to talk about these adjusting entries that I had mentioned about in the previous introduction. And so, again, what you need to keep in mind is that the adjustment process is a process that happens at the end of the period in which you have certain accounts that need to be adjusted. And so we have broken those accounts into 5 categories in which you can memorize in order to understand. Okay, so the first one would be called prepaid expenses. The next one is called depreciation. Third one is called accrued expenses. The fourth one is called accrued revenues. And the fifth one is called unearned revenues. And so basically what we're going to do is we're going to discuss how to properly account for these 5 particular entries, okay? And so the first one that we're going to talk about are obviously your prepaid expenses. And again, what I like for you guys to do is keep in mind of the titles. The titles are everything. The titles give you a sense of how logically the people who created this information were thinking, right? And so when you think about it, you have 2 words here that's defining what this particular entry is: prepaid expenses, right? And so you want to think about, what is a prepaid expense, right? What is a prepaid expense? Well, how about this? If you take a real good look at it, you could consider that a prepaid expense must have to do with something with an expense being prepaid. So that's actually what a prepaid expense is. A prepaid expense is an account that is created whenever you prepay on an expense, basically. So we know what expenses are by now. We have several expense account examples. We have salaries expense, we have rent expense, we have insurance expense, we have advertising expense, we have utilities expense. We have all those different several expense categories. And basically, in order to create a prepaid, you have to do one particular thing. You have to what? Prepay on that expense. Now, the fact that you're prepaying on that expense, you need to ask yourself, did this expense actually happen yet? Did this expense actually incur yet? And the correct answer should be no. The expense didn't even happen yet. But the fact of the matter is that you're prepaying in advance on an expense that hasn't incurred. Okay? So the expense is not really there, and that's the important part about that. And so if you really understand what I'm telling you, then you know that a particular prepaid expense can't be an expense account. It's not an expense account, even though it has the word expense in there, because the expense, the actual expense, hasn't happened. So what is an actual prepaid expense? What type of category does it belong in, since it's not an expense? Well, obviously, it's an asset. And how is it an asset? Think about it. We'll go back to our definition of what an asset is. Asset is an economic resource that provides some sort of future benefit, right? And the fact that I'm paying on an expense that hasn't occurred in advance, obviously I'm getting some sort of future benefit from this particular transaction. Thus, this is why a prepaid expense is an asset instead of an expense. Okay? So first rule about prepaid expenses, they're not expenses, they're assets. Okay? And so in order for us to understand the adjusting entry, we have to first analyze the initial entry. We have to have an initial entry in order to adjust from that with this particular example. And so the easiest way to look at this is to perform an example. So let's suppose that we prepay $12,000 in advance for 12-month rent. And let's assume that the date is May 1st. Okay? So suppose that on May 1st, we prepaid $12,000 in advance for 12 months rent. Now there's a couple of key words that we need to identify in this transaction. Prepaid, in advance of course, and rent. This is exactly what we need, because this is going to let us know where we're going with this. Now based on this, we should be able to identify that we're dealing with a prepaid solely because of the key words. Rent is obviously a what type of account? It's an expense. But guess what happened to this rent? We prepaid in advance. So you should know right there, okay, I have an expense that hasn't occurred, but I'm prepaying in advance for it. Okay, so this rent hasn't happened, but on May 1st, we're about to pay $12,000 out for 12 months rent in the future. So there's an initial entry that's required for this. So our initial entry, well, prepay, right? Prepay is similar to paying, right? Paying is similar to pay. Suppose that we paid. I could substitute that, right? And we already know anytime you see the word pay, we have to do something to cash. Anytime you see the word pay, we credit cash. So we know in the initial entry, we're going to credit cash. But we also know when we prepay on an expense, which is rent, that we create another account. That's called a prepaid expense. And we know that prepaid expenses aren't expenses, they're actually what? Assets. So that prepaid is an asset, and from the business standpoint, it's doing what? Is it increasing or is it decreasing? The prepaid is increasing. So how do we increase assets? All clear system. We're going to debit that asset. So our initial entry requires a debit to prepaid rent, and a credit to obviously cash. How much will we pay? $12,000. 12 months rent on May 1st. Okay? And so systematically, we will go to our ledger, and we have the prepaid, and we have the $12,000 that needs to be debited, and we need to go to our ledger, and our cash account should be credited to $12,000 as well. Now, mainly, guys, I want y'all to focus on this prepaid. Focus on this asset. Right? This prepaid asset is now on the books on May 1st for $12,000. Cool. So that's your initial entry. Now, we normally adjust at the end of the period, which I've already said. We adjust after we finish that first trial balance. That's at the end of the period. Let's suppose the end of our period is in December, the end of the year, right? End of the year. So now it's December. Now it's December 31st. And now it's time for us to make the adjustment. The adjustment. So prepaids are already on the books as an asset, the rent, but now it's time to adjust. Now, this is the initial entry. Understand that we have to adjust something. Something has to be adjusted. And we know we can either adjust it by increasing it or decreasing it. What account is going to be adjusted? Will it be cash? Before you answer that, think about it. Would you wait till the end of the year to start adjusting your cash account? Does that make sense? Does that make business sense to wait till the end of the year, then start touching your cash accounts, cleaning your cash accounts up? more, because more than likely you're going to run out of cash and you won't be able to account for it. Cash needs to be accounted for as it happens. Okay? So the only other account left that we need to adjust is the what? Prepaid rent. Now, as of right now, December 31st, our prepaid rent balance is what? $12,000. But is that the correct balance right now as of December 31st? No, because that's $12,000 as of what? May 1st. So obviously this prepaid rent account needs to do what? It needs to go down. Why? Because it is now December 31st, not May, and rent has been happening. And so this particular prepaid rent amount should decrease. So obviously our adjusted entry will consist of a decrease to this prepaid rent. And the only way to decrease an asset is by crediting the asset. And so with that understanding, we know that our adjusted entry will consist of a credit to the prepaid rent. So we already understand that. We're going to credit this prepaid rent. We have to lower it because time has passed, right? Now, the question is, what are we going to debit? We know we have to debit prepaid rent, credit prepaid rent, but what do we have to debit? Well, think about it. What has happened from May 1st to December 31st? Time. And what has happened within time? Rent has been due. Since rent has been due, rent has been happening. Since rent has been happening, rent has been incurring. And rent, we know, the actual rent we know that's been due is a what? Expense. So what's really happening is we initially had this asset that consists of a certain amount at the beginning of May. But every month that rent was due, this asset should be going down. And the reason the asset is going down is because the expense is doing what? Going up. So you start off with this in the asset, and then eventually the asset does what? Decrease as the expense happens. Get it? And so on December 31st, the expenses happened. And so now we have to record that expense. And when we record expenses, when we increase expenses on the books. How do you increase an expense? With a debit. Therefore, our adjusted entry for this will be a debit to what? Rent expense. And we've already said we know what we're going to credit. We have to adjust the prepaid. So we're going to credit prepaid rent. We're going to credit prepaid rent. Now, this is the correct journal entry. This journal entry will not change from your experience in this particular class as of right now. So you should understand at this level that if you have a prepaid that needs to be adjusted, you always debit an expense and you always credit the actual prepaid account. Okay? Now, the only other thing we have to do is get the amount. We have to get the amount. So we already know time has passed from May to December. How much time has passed is going to dictate the proper amount. What we need to do, guys, is we need to count the months from May through December. And what you need to do, which I strongly suggest, I teach this stuff and I still do it. I use my fingers. Use your hands. So we're going to start from May 1st, May to the end of May, June into June, July into July, August into August, September into September, November into November, December to the, I forgot October. Let's start over. May to the end of May, June into June, July into July, August into August, September into September, October into October, November into November, December through the end of December. So those are 8 months. 8 months. This is why it's important to use your hands. 8 months that has passed. 8 months that has passed. And so initially we paid for 12 months. $12,000 for 12 months. So I did that to make it real systematic for you. $1,000 a month is the rent, obviously, right? $12,000, 12 months rent, $1,000 a month. But we can calculate that because we've already figured out that it was 8 months that's passed. So what we're going to do is we're going to take $12,000 which is the total, and we're going to multiply it times 8 over 12. 8 being the time that has passed, 12 being the actual months. We're going to multiply it times 8 over 12. And obviously that's going to give us what? $8,000, which represents 8 months of rent that is passed. And so now we understand that it's time to post. And so if we post this correctly, we have now reduced our prepaid rent to the proper amount for financial reporting. We know how much prepaid rent we have left because 8 months have passed and we paid for 12. So how much months do we have left? 4. So how much should we have in our prepaid rent account? $4,000. And we do have that now. So consider why it's important. Consider why if we didn't make this adjustment, we would still have on the books $12,000 of rent. Likewise, we've also made the adjustment to increase our rent expense for the proper period. So this is yet a perfect example of how to adjust for your prepaids. I would strongly suggest that you guys watch this example a few times to make sure that you really understand the depth of the nature of this particular transaction.